Good afternoon, everybody. Welcome back to the Opportunistic Trader. Joined for a special webinar today talking about options, risk-reward opportunities. You're going to be listening to Vince Lanci and Tom McEntee. Both Tom and Vince have over 30 years experience trading and trading options, so a lot of great information. I'll let Vince and Tom take it from here.
Thanks, Mike. Guys, we're pressed for time. We had between 100 and 150 people sign up for this, I want to. Tom and I have something we would like to say up front before we get into the classroom process. First, we'd like to thank the Opportunistic Trader for giving Tom McEntee and myself this platform to spread quality educational info for traders who make informed decisions. Subscribers at optrader.com get insights from professionals who have and still manage money for funds, firms, and their own capital. The OpTrader team has skin in the game, basically. This is not a site where grammar school teachers wrap catchphrases in shiny paper. We aim to provide high-quality content at 3 levels. And I don't mean low, medium, and high in terms of education. I mean in 3 different ways. We give real-time information, and that's primarily Larry's trades, which subscribers already know this, but I'm speaking to people. We have listeners who are trying to get an understanding of the site. Larry Benedict, the founder and subject of one of Jack Schwager's Market Wizard books, gives you his trades in real time. Profits, losses, the good and the bad, and as well as the autopsies and analysis for them. The second way that we educate is with fundamental and technical analysis. People that know their industry are part of the team here. Experts in technical analysis are here. This is not some guy with a can of Red Bull, on YouTube saying, I made a lot of money in this and I'm really smart. And then the next day you don't hear about him anymore. The thing that we did not have, but we're adding now on a much deeper level than what Tom and I are doing, but we're initiating it today, is we want a classroom process. And that classroom process has to be able to help people that want to get to the level where they understand the terms that Larry or Tom or Bryn or even subscribers that manage money, people like Sunil and John and Mike. Beginners need to be brought along without sacrificing for experts. And Tom and I think we can do that in the options area. So this classroom is going to be something for everyone. And if you already understand options, you're still going to enjoy it. So basically, Tom and I started this thing yesterday after months of answering questions in subscriber chat. We have a mission, and our mission is to educate in a classroom fashion, give some value to all levels of derivative trader. We aim to make it pleasant and fun without sacrificing content quality. I won't do this ever again, I promise. If you are a first-time listener, be patient. Concepts will be reiterated frequently and returned to. This is a learning by immersion environment, the way Tom and I learned. If you tune in religiously, you will know more about options after 6 months than not 99% of the world, 99% of all financial market participants. I can guarantee that personally. There are those who can do and teach, and I think I know Tom is one of them, and I like to include myself in that group as well. Tom, anything you want to add before we recap the first class?
No, that's fine. I think that you covered everything I'd want to say, man. Go ahead. Recap the first.
I just wanted to blow. I wanted to blow through because we're a little bit on time constraint.
Go right ahead.
I apologize if I'm speaking at a fast pace, but this is how traders talk. So to recap the first class, which is very important as we get into the second class. The first class had a couple main points. One was there are 3 ways options are used. One is to make money through directional expressions, bullish, bearish, or sort of bullish. The second way is to hedge directional investments. I'm long Apple and I'm worried about it going down. I'm going to buy a put. Think of it as insurance. And the third way, the way that we all want to talk about is to make money trading volatility as an asset class itself, whether it be arbitrage, whether it be, looking, I think the VIX is going up. That's trading volatility as an asset class. We're not going to do anything but talk about directional structures today. We're going to be a bank for the listeners, and we're going to give you ideas. All right. The second main takeaway from yesterday was that among all the Greeks, even more important than Vega or volatility, the first 3 you have to learn are delta, gamma, and theta. And some of them have different definitions, but the reason they're important is because delta has to do with direction, gamma has to do with direction, and theta has to do with the money that you pay for direction. We're not even talking about volatility today. Tom, did you want to define those? Just so I'm just not talking so much.
Yeah, sure, no problem. Delta is essentially equivalent stock. Think of it as ESP, 6 cents. With apologies to Bruce Willis. Think of it as equivalent stock position. So a stock with an option with a 50 delta would be roughly, one option would be 50, the equivalent of 50 shares of stock. Two options would be the equivalent of 100 shares of stock. That's delta. So it's equivalent stock position. Now, obviously, that varies as we go out in time and different and distance in or out of the money at that particular point in time. That's a quick thumbnail sketch. After that, we have gamma. Gamma, not like gamma rays, like at the end of Superman, the only 2-part episode in Superman. You go your ways, I'll go ours. We'll go ours.
You mean the red green Superman?
That was fantastic with the wonderful Phyllis Coates as Lois Lane.
All right. All right. We're going to do a webinar on Superman next.
Yeah, rate of change of delta is gamma is rate of change of delta. So if you have an option with a 50 delta and it's got 5 gamma, if the stock were to rally 1 point, the option would pick up 5 deltas. That's the 5 gamma. And conversely, if the stock dropped $1, the option would lose 5 deltas. It would go from a 50 to a 45 delta option. And on an up move, it go from 50 to 55. Theta, as Vince said, that's your cost. That's your theoretical amortization. That's if you're a long holder of options, if you're a long optionality, that is if an option has a theta of 11, that means it's going to come in, if you're long one of these, it's going to come in 11 cents a day. That's on a linear basis. Obviously, the closer we get to expiration, it's going to come in, it's going to be the decay is going to be accelerated and be geometric, but that's a story for another day. So theta essentially is, if you have negative theta, means you are paying for optionality. If you are positive theta, means you're getting paid to be short options. Now, I always throw that phrase around a lot, and a lot of it's, I'm speaking metaphorically, of course, but that's what theta is. Theta is theoretical amortization. What does it cost me to have this position on? How much am I getting paid to have this position on? Those are your 3 things: equivalence delta, equivalent stock position; gamma, rate of change of delta; theta, theoretical amortization.
Right. And if you know those, you have an understanding of your risk if you pick directional plays. So Tom and I use different terms to describe the same concepts. The important thing is to demystify the lexicon so the real learning can begin. So Tom uses things like ESP. I don't, but I'm learning as I'm teaching, hopefully. Today, Tom and I are going to create option strategies that express different risk tolerances. This is exactly what banks do in their structured products divisions when a client says, I'm bullish, what should I do? When a hedge fund calls up and they want a structured derivative, that's what they do. They call up and the bank says, well, we can do this, that, and the other thing, and they give them these ideas. So what we want to do today is we want the audience to give us a stock that they care about. Give us a stock that you care about. Now, I understand that Larry's listening as well, so we might be seeing him type in the chat as well. Give us a stock that you care about, and whether you I'll pick the direction, just for simplicity's sake. Whether you want low, medium, or high risk, I will represent you. I will be the client, and Tom will create the structure. Okay, John Hassinger, Google. John.
Okay.
John. Okay, medium risk. Okay, so that's going to be a hard one for me. Medium risk is hard for me, but I'm going to do it. Here we go. All right. So Tom's the banker. I'm the client. Here's how it goes. Okay. Tom.
Yes.
Tom, you there? Okay.
Yes, I'm here. Thank you.
Tom, look, I made a little money playing hockey, and I'm in retirement. I have some disposable income that I can invest in something. I'm looking to hit a home run, but I don't want to take too much risk. Sometimes it's hard to take profits. I have some risk capital, and I'm bullish. Google. I haven't done my character yet. Okay, so I'm bullish Google. and I think it's going to move in about 90 days. Within 90 days, I think it's going to move higher in 90 days. Can you give me some ideas on option structures for that?
Yeah, sure. The first thing I would do, I mean, Google has too many letters in it for me, so I try to avoid things like that. Because
so then GOG maybe.
I got it.
One of them has voting rights, and one of them doesn't, right?
So I'm assuming you're looking higher, I guess. I like. I mean, how much higher? I mean, it's always good to work with a target, but absent that, not want to slow things
no,
up.
No. That's a question you're asking me, and I'm going to answer you. I was a hockey player. I was hitting head a lot, and I have to think about this. I think we're going to have a 20% move, in the next 30 days, unless yes.
That may put us at old highs, right? I mean, I just looking here, 20% would roughly be, $214 would put us at the old highs, coincidentally. Did you just
really?
That's
okay. So I got money to spend. I'm willing to tolerate a little bit of downside risk. Give me a structure, please.
Sure. Now, the first thing I want to say is look, I say this a lot when I speak with Mike, is that you want to look at 90 days, and we're thinking maybe 1,300 in this thing. All right. Well, let's go. Wait a minute. I just want to minimize this screen. Okay, fine. I want to go to. Let's go to Jan. All right. So the first thing I want to say, look, Google,
I got 10 grand. I have 10 grand to invest. Okay, and I'm willing to lose another 5 if I'm wrong. How's that? Does that help?
That's an important thing, because I think what you got here is you got an $1,100 stock,
right?
So it's not like trading. It's not like trading telephone. It's a different thing. You got to be cognizant of it, right? It's a higher vol stock. Well, right now it's a higher vol stock, and it's $1,100. So you're looking. It may go to 1,300, and you're looking medium risk.
Yeah,
I would say. I mean, without getting too. And I think the first stop on this way station might be 11, sort of like that 1175 level. I would look at something like this. Yeah, I'm going to put this in a strategy.
But that's technical stuff. I don't understand that. I just think it's going to go up 20%, and I don't want to spend too much money. And I want to be long.
Understood. Okay. Well, let's do something like this.
Like, I don't mind selling something to finance buying something, but I'm not crazy about blowing out if we go down too much.
I would do something wherein you can, you like it, you're crazy bullish, and I guess your seasonality may support that. Certainly today does. I would look at something like this. I mean, just here's a small, light delta. As you can see here, do you see this? Yeah, about 7 deltas, okay?
Right.
You see that? It's about a 7 delta spread. The Theta be about $0.10 a day. Okay, so the spread will cost you. That's the market in the spread. $2.40 bid at 3.6. It's obviously it's fluid, so it continues to change. Okay.
Wait, how many of those can I buy for $10,000?
Well, you can buy 30 of them. Okay, 30 of them at $3 a pop would cost you $9,000. So you could buy 33 of them. Yeah, okay, you can buy 33 of these spreads. Now, I'll give you a profile. Let's look. Hey, I mean, with something like this, you're looking for an explosive type move, right? You're not going to get 20% and give away the first 14 freaking days,
right?
You only got you got 90. You need something to happen somewhat immediately. So I would say this particular spread, I want to look at at 2 weeks. Let's see, we get a 10% move in this stock. I mean, we're going to bet $3. If you're right, if we get 1250 in Google. If we get 1250 and I'll show you my profile, what I'm looking at here. Now, this is Google on December 14th. This is a pre-and-L chart.
Okay, but that's not an expiration graph, correct?
No, it's not an expiration graph. Okay. I'm looking at a specific point in the future. So I want to look at 2 weeks from today. Hey, we're somewhat time sensitive here. I know we got 90 days or 30 days. But I think something like this here, December 14th, 2 weeks out, we could buy a spread like this where without getting too freaking geeky and stuff like that. We're buying January options, selling Feb options, and we're taking in volatility clicks because it can.
Wait. You want to do a calendar spread?
I want to do a vertical. It's sort of a diagonal spread. I'm going to buy the January 1175s sell the February 1260s. I'm going to pay $3 for that.
Tom,
Now,
that's too complex for me.
that's too complex for you. Then you want to do let's just do it's sort of a vertical. Let's do this then. All right. I will do this.
I want to be able to set it and forget it. You know what I mean?
I got
I don't
you.
want to.
Point taken. No problem. Okay. Something like this. February. You can buy the Feb 1200s, sell the Feb 1260s. You can see this obviously, right? Right here.
Yeah.
That would cost you about $9. Well, I'll go split in the middle. Think about $9. That would
Okay.
cost you $9. So you could buy that's about 900 a pop. So it costs you about you buy 11 of them, 10 or 11.
Okay. So
Okay.
so I would be long the call, and I'd be sure to call against it to kind of finance it.
Yes,
but I don't make money if the stock goes up to infinity, right? I mean,
no, you're gonna. I mean, look. I mean, nothing goes to. They don't. Trees don't grow to the sky. I just made that up. Trademark TM. That I think this is going to give you attractive risk reward characteristics. Number one, without getting too crazy, and we're going to come back to this. So I might as well throw it out there. I'm not going to explain it. Flat skew, flat vertical skew, or flattish vertical skew, I should say. Okay. That being said, I could pay $9 for this. My max loss because my max loss is $9. Now, at X, like if the stock trades 1,300, if I'm right about that, that spread's worth $60. So I make 51. So I'm getting like 5.5 to 1 on this, 5.5x on something like this. So it's a good structure there. But it's important to know, hockey player, that we don't need this stock to trade at 1,300 by Lincoln's birthday or whatever the heck that might be. Look, if we get close, if we tickle like 1180, 1190 in the next 3 or 4 weeks, this spread's going to be this spread will be like a triple. So that is a medium risk play that could give you has real attractive risk reward characteristics. And of course, and I think I'm glad you brought it up, hockey player. I'll call you Nicky Fatiou. I'm glad you brought it up, Nick, because I think it's important to realize that with five symbols, with 5 letters in the stock symbol, you got to be careful how much you're buying. You have to, and it's a $1,200 stock, so you can't buy as much as you'd buy in a $30 stock. So you always got to be aware of it in terms of the dollar amount of the stock and the volatility of the underlying. That's a story for another day. But
okay,
I would buy something like this. Buy 10 spreads, $9. You're getting 5.5x. We ain't going to stay in operation.
So done. I'm going to buy a call spread.
Yes, that's a good.
Okay.
Point.
All right. That's good. That's good. Okay. All right. Okay. All right. So I have a friend of mine here with me. Tom.
Yes.
Tom, you there? Yeah. This is Bill Jenkins III. My friends call me Trey.
You sound like a Native American, one who can trace his roots directly back to the Mayflower.
I was hella skiing yesterday, Tom, and I heard that NVIDIA is going to go a lot higher in the next 60 days. I don't even know what NVIDIA is. I have a lot of the stock in my trust fund. I'm really not that concerned about money. I have plenty of it, but I just like to win. Would you? What kind of thing can I do if I'm bullish on NVIDIA? Risk is, for fun, I snort Ajax. So, I'm not really worried about risk. Pygow is just too slow of a poker game for me. So can you give me an idea there for me and
absolutely. NVIDIA, well, it's interesting. I mean, I would imagine that you're in a better spot to like it than say 2 weeks ago when the stock was considerably higher and then took it.
Tom, I don't even care about that. I just want to be able to talk about it at the club.
You and I cuff from the same cloth. Well, I would look. I mean, just a quick. I think the stock's going to fill the gap. I think all these are going to fill the gap. I think just my personal opinion. There's just too much bearishness out there with technology. So that means everybody can't be right. So I think it gets in here. Is that okay for you? Would you be okay with this 190-ish level? Or actually, this level is.
I don't know how much it's going to go up. I just whatever
well, let's
I
say
have to do.
155. And what do you think? Are you looking? I sense you're a little more risk aggressive than Nicky
Well,
Fatia.
yeah, my dad finances the risk. I'm not worried about that. So what can we do so I can really have maximum leverage to make money if it goes up? But I can't buy stock. I'm not allowed to. I have too much already.
Okay, let's look at NVIDIA. Here's our NVIDIA option page. We think it may go to 190, and let's say there's some type of a certain symmetry to it, and it happens there by Feb or something like by the earnings and stuff like that. You're very bullish on it.
Well, yeah,
and why
yeah.
not?
I mean, my uncle's probably going to buy the company. I mean, I should probably do something.
And you want to get outsized. The most aggressive play, and I wouldn't recommend this for those who. This is a bold play.
Okay.
Bold play.
That's what we do in my family.
I like the way you pronounce family.
Exactly.
So we're going to go. I mean, 10% will be 175. I'm sorry, my bad. Let's look at the 175s, and 10 down would give me what, about 142. We'll say the 140s. Here. 10% up and 10% down. 16 would be 142. I can sell these at 140. Here's this thing here is a risk reversal. Now, the way I understand risk reversals, that there'd be some type of stock attached to it. But this, for our purposes here, and you like the stock, I think you can probably leverage this. Where this recent low, 133 and stuff like that. I'm with you. I think the stock's going higher. The way I play it, for the most bang for my buck, will be something like this. I can buy a 10% out of the money call, or it's a little bit higher than that. Buy the 175 call, sell the 140 put. Okay.
Right.
The debit on that will be about $1. We'll keep it simple. It's going to cost you about $1.
Okay.
Or I'm buying February 175 calls. I'm selling February 140 puts. I'm paying $1.
Okay.
I'm looking. Look, if this stock closes anywhere between 175 and 140, closes. When it's like we're not going to hold it to closing. The thing expires worthless. Okay. Our risk is we lose. We're dollar for dollar on the downside below 140 risk. We're dollar for dollar on the upside 175. So the way I'm looking at it, if I'm interpreting the charts correctly, you might have $7 of risk down to that 133 low. I believe, on 1120, and I think you're going to have roughly 50. So it looks like about $20 of upside to that 195.5 gap fill from the earnings date of 11/13. So I think
a risk reversal.
Yes, that's called a risk reversal, correct?
And I make money above a certain price, then I lose money below a certain price.
Yes, you're going to lose anywhere between 140 and 175 at expiration. Is a scratch. You're just going to lose the dollar debit. But anything above 175 is a winner. Anything below 140 is a loser.
Yes, my commodity friend Winthrop, he calls those fences. But yes, I understand. Can we do something more aggressive?
More aggressive. Okay.
Can we can we create a share of stock synthetically so I won't get in trouble?
Is that what you want to do? I mean, that's fine. It should. This year is quite bold. But if you wanted to go, look, if you're
my losses aren't my own. It's not a problem. What I want to get aggressive. I want to, I want something that's longer than, what do you call them, deltas? I want something that's 200 deltas. Can you do that for me?
Absolutely, I can do that for you.
Okay.
200 deltas. Let's do something like this then. Let's buy the Feb 75 call.
Uh-huh.
Let's buy 2 of those. My dog is. That's one. I mean, they're 175, 160, 190. You want 200 deltas.
I took my dog to the vet yesterday, and we either had to have him shaved, because his hair was long, or not. So we just gave him away. We didn't want to spend the money on shaving, and we went out and bought a new dog. But that's how we roll.
Well, you're in a whole. You're probably going to Piping Rock for the dog show. Now here's one with. This is very, very bold here. You ready? Now, we see nothing but green lights for this stock. Here's one that give you 150 deltas. I can buy 2 of the 175s, sell 1 of the 60 puts, sell 1 of the 45 puts.
Okay.
That's 155 deltas. Theta's
Okay.
I'm going to take any credit on this. I'm going to take in roughly $7.60, $7.50. We'll keep it simple.
Okay.
So that means anywhere between 175 and 160, I pocket the $7.50. Now I have losses accruing down below 160.
No, we're not worried about the losses.
Yeah, of course.
We're all about the risk.
They're other people's problems.
Right, exactly. But can I get even longer with one structure? I want to get longer. You know that collar or risk reversal? Can we do something with in the money options that way?
Well, we could do. You could do. This would be a 160 reversal. Is that something you're looking for?
Yeah.
Cool.
How about we do the synthetic stock, right? Like you suggested at first.
Yeah.
Where was I sell a put and I buy a call at the money?
Yes.
And then what else can we sell to get me up to 200 deltas?
Wow. I mean, what else can we sell? We could sell another put. Is that what you really want to do?
Yeah, that would be cool.
2 of these?
Yeah. 2 of what? 2 of the same strike?
They'll sell 2 of the same strike.
No, you're just going for more commissions. Can we sell a higher delta put so I don't have to do so many?
In the money put? God bless you. You know what? That's fine. I mean, you could do a buy right. I mean, but you seem like you want to have more juice in the game. You don't want to limit your upside.
I'm not doing a buy right. I'm just doing a buy and it's going to go up. And if it doesn't go up, it's not my problem.
Why don't we do something like this? Why don't we buy the 175 call and sell the 175 put?
Okay. How many deltas is that?
That's only 100 deltas, but
I want 200, Tom. I need more.
Let's buy it in the money call then. Here's
okay.
125. I could buy the 150 call and sell the 175 put. Why don't I just you?
Oh yeah. That sounds cool. So my dog just told me that's called a guts collar or guts risk reversal.
Yeah. We're going the other way, but yeah.
I don't know these things.
The 140 call and sell the 180 put. I mean, this is double trouble. Obviously,
I'm not. I've already signed a disclaimers. It's okay, and I know you're going to front run me anyway. Just let's just do it. Let's just do it. Put it on.
Well, that's one way. That's certainly a very, very bold play. But fortune favors the bold, I believe they say. That's
exactly. And all my losses are socialized. Pardon me. I'm opening a bottle of Sauterne. Okay. All right. So basically, that's a real aggressive play. High deltas, not worried about losses, and certainly insane. But people do that. Guts, fences, 1x2s where you buy 2 calls and sell 4 puts, that type of stuff. That's cool. We're actually running low on time. We'll tighten this up as time goes on, but I want to do one more. If Larry's out there listening, he wants to throw something at me. If not, I'll pick oil because Sunil mentioned oil. Do you can you pull up oil on that?
Let me see. Hold on one second. I never really tried it, to be honest with you.
Because I know that it's the future, so it's like
I don't know if I'm. I never really traded it.
Okay, see if you can pull up a stock. Royal Dutch.
I got it.
You got oil?
Yeah, that's cool. All right, it's Sunil wants this, right?
Yes. Is this oil or the OVX?
This should be crude oil.
I want to make sure that it's the future as opposed to an ETF. That's all.
Where's Jan 19 crude? Where's January 19th? 51, about 76. Is that right? Yeah. Okay, that's cool. That's what I got. Okay.
Okay. Sunil, high, low, medium risk. I'm out of character. I have to do better characters.
So I want to do something in crude.
Yeah.
Let's look at.
Hey, Tom. I got I lost a lot of money in Bitcoin. I got a little bit of money left, and I'm bearish crude oil. I think it's going down. But you know, I got to make sure I have money for the Kung Fu Grip GI Joe for my kids for the holidays. How can I you know play that? Of course, you'll give me information before you call your institutional investors. How could
Yes,
I play
so you think crude's going down? I wish you thought it was going down about $25 ago, but that's okay. I digress.
Well, I am the retail, and I am selling the lows. But you know, so what could I do? What could I do? And by the way, if I lose money, I'm just going to declare bankruptcy. So we can do a ratio back spread if you want.
Yeah. So you're thinking maybe what are you looking at? $47 in the stock, $48.
Yeah, sure. Now, my friend Sunil talks to me about things like skew and premium. I don't know much about that, but if I could put on something that I can make money if it goes down without spending money, that would be cool. Even though I don't have a lot of money.
I got you.
You want to go to Chinatown, boy? What's your dog's name?
Bruno. He's about 11 pounds.
Bruno, you want to go to Chinatown?
down.
It's actually not true. However,
do you think it's going lower? You know what I would advocate, to be honest with you, in crude? Vol's very high in there, as we all know, and for obvious reasons. I mean,
but it's just directional. I don't care about volatility today at this moment. I'm just, you know, I don't want to spend money because I don't have much money, and I think it's going down. So, what can I do?
I got $2. I would sell the March 50-54 call spred.
You would sell a call spread?
March 50-54 call spread. I'm betting $2 to make $2.
How does that make money if we go down? Is there a graph of that you can show me?
Yeah, absolutely. Here, look at this. It's interesting enough. It's in a profile. Okay. I want to look at
Bruno dim sum. Didn't work.
And here we look on GM1. Okay, this is the stock right here, 52.21. We're going to profit anywhere between. You got to realize we have fixed risk and a fixed P&L. Essentially, we're betting. It's a $4 spread.
Right.
We're taking in roughly $4. We're selling it at $2. So essentially, we're betting 2 to make 2. So it's an even money proposition. The beauty of this is if you're going to move down to 50, you're going to profit there. And you're not going to participate anywhere below 50. Your profit.
No. So basically, the money I collect is the money I can make.
That is correct.
Okay.
Because I would be serious. You see my stuff in the chat. I'm a buyer of volatility. I tell you to get long optionality if vol was at depressed levels. I can't, in good conscience, here, Sunil, tell you to do that at these levels. Now, that being said, the stock will probably trade 46 tomorrow. I understand that, but that's one way of doing it. Or if you're really convicted about direction, you think it's got 46 written all over.
Listen, just because I don't make a lot of money doesn't mean I've been to jail. Okay. I've been accused and indicted, but never convicted.
Like the scene in Stripes. Or you maybe buy the 50-46 put spread in March. Cost you about $1.40. That's another one. Now you're getting 2.6 against 1.4, right? So you're getting about roughly about what is that? You're getting about $1, almost 2 to 1, right? What am I getting? I'm getting 260 against 140. I'm going to get about 180 to 1, $1.80 to 1, like 9 to 5. That's not a bad deal. That's another way to play it. There, you're at 50, you're just going to break even.
Okay. So I think we have to. I'm sorry to break. I think we have to wrap up. It's 12:51, and I know Mike needs a thing back. We're going to do this again and more and better as it goes on, because of we lost time in the beginning and the introduction and everything. But basically, a low risk person either buys, either spends money he can only afford. A low risk person is low risk, low reward. A medium risk person is medium risk, low to high reward, and a high risk person is high risk, high reward. Does that make sense?
Yes, that makes sense to me.
Okay.
That makes sense to me. So we have something in crude oil. Like I can obviously, for anybody out there listening, these things, Vince and I can obviously tailor these things to you, and we can firm it up. That's not a problem. We do the purpose of this exercise was to show you what strategies are available. Like I'm a spreader, so I come with that kind of bent, so to speak. But
Yeah.
there's so many ways to skin a cat, and we'd like to give you, Vince and I. I'm not going to BS you and tell you to do something that I wouldn't do myself. So that's where we're coming from. Look, I'm fully cognizant of. I think we both are that crude could go to 45. It could go anywhere the hell it wants to go. But I
Right.
think that at this particular juncture, I got to think I probably missed the move. That's how I would play it, and I don't want to be a buyer of optionality at these prices. With also the fact that you've got seasonality in here, you got some holidays coming up. So I am vol of I'm Vega averse at these levels. You know, if you want to give it away to me, yeah, I'm buying it. But
Okay. So
we're stuff. That's
we're going to talk vol. We're going to talk vol for a second. All right.
Yeah.
So oil. I'm going to throw this in there. Oil. Sunil. Volatility's high. If you're bullish, sell a hedged put spread. Vol's going to come in as you go up, and you're going to make more money than you lose on your hedge. If you're bearish, sell a hedged put spread, but make the deltas more like 40 to 20. Because if we go down, the negative gamma from the 40 delta put is going to be dwarfed by the change in vol in the 20 delta put. So you'll make money both ways on that. Selling a hedged put spread, to Tom's point, is sell premium, sell vol, but buy change in vol. So if the market goes up, you're okay. And if the market goes down, you go into your long position. So change in vol is important in crude right now. If you want to play naked, you would just obviously do a put tree, or if you're bearish, or 1x2, or if you're bullish, do a 1x2 where you buy one call and sell two to collect premium. But deltas matter when we start talking about stuff like that.
And to your point, Vince, I'm sorry. You kind of want to think. I mean, we were kind of always taught this way. Where do I get paid? And you're getting paid to sell stuff now. And you're right. the hard betting crude. The hard betting crude is to bet up, right? And it's always been my experience in my 30 years. The hard bet's usually the right bet. And there's some things you can do. I don't know where this. Look, on the upside, you could do a lot of low risk stuff. Look, if you want to be agnostic about direction, you could avail yourself of the volatility. Do something like this. Buy like the 57.61 1x2. What would that cost me? That's a slight delta.
Jesus, Tom. I don't don't start. You're going to get me doing that too now.
It's a nominal debit. You know, look at it this time. I want to do the 57.61. The 57.61. You can take in a slight credit at expiration. Look, nothing goes to expiration. I get it. You got a room up to 65 plus the credit plus the dime. You got a lot of room. The stock. I think that was the month. That's a good do.
We got. I'm sorry, but I think I just got the notice. We got to go.
Okay, not a problem.
Folks, thanks for listening. This is just the beginning. There's a lot more coming, and it's an evolutionary process. And we had 150 people interested in this today, and we expect it to be more tomorrow as time goes on. And there's a lot to learn. Please take a look at the post we have called the Option Class Cheat Sheet, because that'll be part of tomorrow's class or the next class that we do have. Thank you so much. So, Sunil, are you bearish or bullish? We only have like 30 seconds. Bearish or bullish crude? Because this is my wheelhouse.